Hello, how are you? I hope you're having a great day. I'm down here in the kitchen dining room today, so a little bit different view in the background. But I've got something really exciting to talk about asset depletion, which, in simple as I can say it, it's when someone has a nest egg and not enough income to qualify. We do a formula on the nest egg and count that as income, or some of it as income. I'll go through the details here in a second. First, I'm going to show you a little bit, if for those people that are really into the minutia. Let me just make sure I get this up a little higher. Okay, so asset depletion follows the Fannie Mae guidelines. This is on our portfolio products, which jumbo, and we have some conforming arms, but jumbo fixed in Texas and Oklahoma only. Assets from inheritance, sale of a business, investment earnings are acceptable without adjustment. So that's different than Fannie Mae. So when you're looking for a lender that's just follows Fannie Mae guidelines on their jumbo product, they won't be able to use those asset accounts towards calculating this income. And the other big thing is we divide that nest egg by 120, not 360. So our income number is 3 times the income that other lenders can use, even if they have this program. Lots of lenders don't have this. So let's switch things out here a bit. I'm going to hide that. We're going to go big. This is a simple calculator on how to use it. So let's say you've got somebody that has, let's say, $2 million in the bank. Okay, and they're going to use 200,000 or 300,000 for closing. So that leaves $1.7 million as an asset. Are they retirement age, under 59 and a half, and retirement account? Yes or no? So I'm going to say no. They are not under 59, so they're over 59 years of age. So there's no penalty on an IRA or 401k. You'll have a takeout penalty if you're under 59 and a half of 10%. So I would calculate that if that was the case. So that leaves us with $1.7 million. We divide by 120, and that leaves us with $14,000 of income that we can use for this consumer to get qualified. Let's say they have Social Security also of, let's say, $3,500 a month. So they've got a total of 17.6 thousand that we're going to say they have income. We don't actually have to see them withdraw that money from their asset account. And so when we multiply that number times 43%, which is the maximum debt to income on these programs, it leaves us with 75.96 of monthly debt that they can qualify for. That includes their current mortgage. So you're going to ask, well, how much house does that buy? So let's say they're going to buy $1.5 million purchase price. They're going to put 20% down. That's $1 million, or that's, oh, I got too many zeros. Let's do $1.5 million. With 20% down, that's a $1.2 million loan amount. Interest rate, today on our portfolio jumbo, we're at 3.1%. Today is, what is it? November 2nd, Game 6 of the World Series. Go Astros. And so we're going to estimate, there's the principal and interest payment of $5,100. I'm going to estimate Texas taxes per month and insurance, additional $3,000. So there's a mortgage payment of $8,100 that they can qualify for. Oops, so I don't have enough, do I? So this guy would not qualify for that mortgage. Let's change things up a bit. Let's say it's $1 million house, 20% down. Mortgage payment is $5,400. So in that case, they do qualify. Let's go big. Let's say the guy has $5 million. Let's say they are under 59. So I'm going to put a yes there. So that puts the penalty there. We're going to say they have a regular job because they're under 59 and a half, and they make 12 grand additional a month. That's a family. So they've got 47 grand using this asset depletion number of 35 grand because they have 5,000 in assets. And then you can go big. Let's say they're going to do a $3 million house, 20% down again, and there's 16 grand. So it's under the 20 grand of what they would qualify for. Of course, we don't know about their debts, but anyway, this is a game changer for retired folks that are wanting to buy that big house and they're only getting Social Security or maybe a pension. So most lenders are going to say, sorry, can't help you. And they end up pulling the cash out of that nest egg and pay cash for the house. You don't have to do that with us. You can keep that money in your nest egg. And hang on, let me get my face on the screen. There we are. You can keep the money in the nest egg. The financial planner's happy because the money's still in the nest egg. You've got it invested in things, stock market's roaring. What else have you invested in? But you don't have to buy your house with cash. You can borrow money through this asset depletion program. And again, we don't ask you to actually pull money out of your account. We don't want to see 3 months of withdrawals or anything like that. So it's a pretty cool thing. So again, oh, I didn't ask you to subscribe. So if you're still watching, please subscribe and comment below and share with your friends and have a great day. Thank you so much.